So, Brittany, are we live?
Yes, we are.
All right. So, let's get to it. All right. Hello, everyone. My name is Gershon Margolis. I am the founder of Imperial Advisory. We are a fractional CFO firm. We work with CFOs who have an accounting team but still need help. And with smaller companies, we work for CEOs that usually have an accounting team but have no CFO. And we do strategy, analytical work, mergers and acquisitions, all sorts of fun stuff. Audit readiness, like I said, lots of fun stuff. We have an amazing team. Most of the people on our team have 30 to 40, sometimes more years of experience. So you're dealing with, we come with a very high caliber team, lots of great experience. Many of our people have been CEOs or COOs as well. And we go into clients, and recently a client told us, quote, "I wish I would have started with you 2 years ago when we were introduced. I've used other people. You guys are the Rolls Royce or Mercedes." That's what he said, Rolls Royce or Mercedes. So anyway, so that was nice. And that's really a testament to our amazing team. Anyway, we, besides for working on day-to-day finance, we try to help our clients with all sorts of things. And, it's not just about numbers and math. It's also about making smart business decisions, and lots more. We recently helped a client get a PEO. We try to make good intro. We're not HR, but we're helping them get what they need in place. And we get involved in all different parts of business. One of the aspects of business that's important to keep in mind is risk management, risk mitigation. And that's really the topic of today's webinar. Now, today's webinar is risk mitigation that actually relates very closely to money because it's mitigating risk on your revenue cycle. So I will introduce Ellie in a moment, but first I just want to say thank you to Brittany for putting this all together. Thank you to all of our guests and teammates for joining. I usually introduce our teammates. So far, the only person from our team whose face I saw was Barry. So I think we do have at least maybe one other person here, but I'm not sure who. So welcome, Barry, one of our amazing CFOs. Thank you, Brittany, for putting this all together. All right, now we will jump into today's topic. So like I said, credit is very important. Some people say credit makes the world go round. Selling things is important. Oftentimes, if you want to sell, you have to extend credit. How do you do that? How do you do that safe? Ellie is an expert in that. We recently shared a client for a while, and if I recall correctly, a company can be involved in, and perhaps Ellie will talk more about this, a company can be involved in both ends of this, right? A company can, let's say a distributor, right? They can be the subject of credit insurance. Someone can buy credit insurance on them. They might also want to buy credit insurance on all the people that they're selling to. So this is really, it's an important and very relevant topic for anyone in manufacturing and distribution. And Ellie's got lots of experience doing this. And so without further ado, welcome, Ellie. Looking forward to learning a lot of important things. Please introduce yourself and let's get started.
Thank you. I appreciate it. So let me give a quick introduction. Ellie Wiener. I have a company called CRS, which stands for Corporate Risk Solution. And we are solely a credit insurance brokerage. That means we do not sell liability, disability, and all the other insurance stuff. We only sell credit insurance, or some people refer to as AR insurance, trade credit insurance, all the same thing. That is our brokerage. That's what we focus on. We've been doing this for over 10 years now and loving every minute of it. Happy to talk about credit insurance, if it's okay. Guys, I think more of like an interactive. I'd love people to ask questions. I find that then when somebody just rambles off and gives a speech, it gets boring. So unless that's the kind of vibe that you're looking for, I'm happy to be interactive, ask questions. I want it to be able to pertain to your scenario, your cases, or whatever is going through your mind. I always say to niche business, 99% of regular insurance brokers, they probably don't even know what credit insurance is. We work with a lot of different irregular insurance brokerages, which will call us and say, hey, my client needs credit insurance. I don't really know how to deal with it. I don't even know what it is. Can you just deal with it? Take care of my client for me. We're happy to do that. We work with a lot of different brokerages. We have partnerships with them as well. So that just gives a little bit of introduction about our business. Yes, Louis, you asked, how do you work with factors? I'm going to note that and we'll get to it. Thank you, Louis. So credit insurance, I'm going to give you these, what we'll call a 2-minute elevator pitch, what it is. There's 4 primary purposes. Let's go to the first purpose. Obviously, you have disability, liability, workers' comp, every other type of insurance that exists. But your largest open asset is your AR. So companies' AR is, you know, a revolving asset, which kind of, it's not just a single risk. Your building is a single risk. If a fire happens, your AR is a risk spread across many, many different companies, and you don't know which one are, you know, can go out. So sleep insurance, I don't need to be concerned. I have insurance if my customer goes out of business. They don't only have to go bankrupt. They can just what's called protracted default. My client is not paying me. I need to file a claim. You're covered for that as well. Jumping in second component, we become your credit management department. We advise who to do business with, sometimes who not to. So we become, in essence, an extension of your company where we run the risk profile of your customers. So if you have, you know, sales guys, and he's had a show in Vegas, or he's had a show in Miami, and he gets a new customer, go put it in, get it approved, go ahead, do business the next day. So you're running that risk factor off to an insurance company. And we're not just standing behind and advising who's good, who's not. We're not just a D&B or an Experian or any other type of credit profile. If we tell you this guy's good and he's wrong, we're going to write you a check. So we're not just, you know, shooting out hot air. We're advising with a check behind, standing behind us.
Quick question. How does that compare to having an internal credit team? Does an internal credit team cost more or less than
good question.
Paying you guys?
Let me give you the quick answer. We can unpack that and elaborate it more later on. You know, I always say you're in the business of your business. These guys are in the business of running credit, knowing who's good, who's not. You'll never be able to compete up against the big companies. And when your internal credit manager or lady makes the decision, this guy's good, this guy's not, if she's wrong, you're still left holding the bag. So what ends up happening is that these credit risk people in your offices generally become very strict because they know if they say this guy's good and he's not only will you be stuck holding the bag, she's going to lose her job. Because, oh, you said to ship this company, now we took a major loss because you get out. So what we see is a lot of in-house credit managers become very strict because they're protective of their job and because they're protective of the company, and ultimately restricts all the salespeople from going out and trying to sell like crazy. So it's going to be very difficult for your credit person to go make a decision on a company in Atlanta that she never heard of. And now she's got to do credit references and she's got to call. And of course, whose credit reference are you getting? Uncle Vinny and cousin Tom. I mean, you're not getting the real credit references of what you're really looking for. So I think that gives you, let me know, Gershon, if that kind of answers your question, where the credit insurance company can do a better job at credit management than your own credit person. I'll end up with one story about that. I once met a company, a client, a prospect, and we were having this discussion. He's like, what's wrong with my current credit practice? So I said to make you a challenge, David. If I can show you how I can make you $1 million, just $1 million in sales by having the credit insurance as opposed to what you're going now, you know, will you be a client? So he thought about it. He says, you know, 100%. If you do half of that, I'll be a client. And I showed him certain customers the insurance company was approving for much higher limits than his own company was approving. He's been a client for I don't even know how many years by now. Very happy, doing hundreds of millions in sales. So
go ahead.
go ahead.
Okay. So in in finance, we have this concept of, like, if you have insurance, if you can pick where you're offloading the risk, you're going to offload the high risks and kind of keep the low risk for yourself. So do you find that when someone's a good credit, the company's like, well, why should we pay you? But you're just getting all the garbage credits, and then or is your business model built on you taking all of it? And so we get the good credit where we know we're not going to have to pay out, and we'll have to pay a higher rate on the bad stuff, but it all kind of works out. Or do you not insure anything bad?
Great question. I mean, look, if companies are really bad, they're not going to insure it. Just to give you an idea, you couldn't get coverage on Big Lots and Joann's and Party City and Red Lobster and Spirit Airlines. These guys all just filed bankruptcy, but you couldn't have gotten credit for a couple of months already before. But whatever people had was already insured, and they got paid on that. Regarding going back to the first part of your question, before you even get a policy, we go for a quote. Going for a quotation process is, hey, Stephen, give me a list of your top 20 customers, your highest risk customers. I want to prove to you that I can get coverage on those customers. If I can't show you and dress to impress that I can get you covered, not just on the good ones, but also on the riskier ones, or the guys that you don't know, I'm not sure how much business we can do. And we always surprise people. We will always get you more. Of course, there's cases that we can't. Generally, we're always going to do a lot more. Now, generally, we write a policy on the entire sales portfolio. Like what Lewis asked, when there's a factor involved, you're kind of double dipping. So we'll insure just a portfolio that the factor is not on. But we work heavily with factors all the time. In fact, I think Lewis stepped away, but I guess I'll address it when he gets back because it was his question. But generally, we're doing the whole portfolio. I call it insurable sales. We do not insure COD because there's nothing to insure, so we would exclude that portion of the sales. We don't insure Amazon sales. I just don't feel that there's a need for it. Sometimes we'll exclude Walmart, but overall, we're including the entire portfolio generally. Intercompany sales, there's always that. That's where you have to have a conversation about exactly to understand each person's portfolio. It's not just a one, give one, take all type of thing.
Got it. Thank you.
Sure. I'm going to continue on. Third component, why people get the policy, obviously growing your sales. I always say, I'll be your cheapest sales guy. Our team, we have a couple of sales guys. We have a team of girls in the office as well helping out. We are there to help you grow your sales. You're going to, God willing, get a policy, do a lot more sales because we enabled you to grow by not taking the risk, and you can do business with this guy, with this guy, with this guy, and with this guy you gave him $100,000 credit limit. Well, what if I approve him for $250,000? You can do a crazy amount of more sales now. Or this guy, you're limiting him. What if we approve him for more than your current credit in-house process is? You can do a lot more sales. What if your process on new customers is, hey, COD for the first 6 months, which is very common? Well, what if I approve him from day one to get terms? Hey, now I can really push my sales. I can really grow. So at the end of the year, you'll come back to me, hey, we grew 10, 20% without even having any claims. And of course, if you have claims, obviously that's what you have in insurance. Okay. So the idea is you'll be able to grow and expand your sales, especially outside your comfort zone. It may be the tri-state, it may be a certain demographic, but now I can expose you to companies anywhere in the world. It's not just domestic. We have guys selling all over the world, whether it's to Europe, Australia, obviously Canada, but South America, South Africa, anywhere in the world. It's not just limited to domestic. These companies that we work with are global. And then fourth, banks like credit insurance. A bank will generally give, better lending, higher lines of credit, better rates. That's something you're going to discuss with the bank. I know Lewis asked about the factor. A factor will lend against receivables that are insured. We have lots of factors that we work with that want the receivables insured so they can lend against that. So the factor will say, well, we're lending against the invoices from TJ Maxx, Marmaxx, Walmart, and all the big ones that we know, but generally the factors don't have information on companies outside their portfolio, which is, usually the publicly traded ones. So the insurance company will get you the coverage and they will lend on what's insured. It's very common. We have it all the time. So, and Lewis, you asked about the factors, correct? So just what I was saying before is that we generally exclude the factor sales. Otherwise you're doubling up. So you don't want to have the factor, you're paying for the sales, I'm making it up. Let's say it's Walmart sales, you're paying for the factor, but you don't need to be insuring it through us as well, you're double dipping. So we would exclude the factor sales and just write it on the sales that the factor is not covering, and then the factor can come and lend on those sales. So that's generally the way it works, but we work with factors, very common all day.
Thank you.
That gives the gist of credit insurance, what it is and how it works on a day-to-day. So the idea is somebody has a policy. I always say, what's your current, my first question I always ask companies, well, what is your current credit practice? And I find I'll get a lot of hee-haw, and there's never a real practice in place that really personifies a company and makes it a real foolproof way where they're not losing sales and they're not losing money. Because a lot of times to find the fine balance between I'm losing sales because we're being restrictive to I'm not being restrictive, I'm going crazy, but I keep getting hit from customers that are not paying their bills. You have to find that fine line where a company can really capitalize and make proper financial credit decisions. So like what you said, this is called risk mitigation and risk management. How do you properly manage your risk and mitigate your loss? That's what it's about. So I guess we'll start from there. We can talk about many different scenarios, but anybody have any questions, or we can keep moving forward, moving to different scenarios and different ideas of, you know, companies in different across the spectrums that need it, that should have it, that I would jump into. Go ahead.
We have one question in the chat, and everyone, please, you know, Ellie said he really wants us to be interactive, so you're welcome to jump in with questions or drop in the chat. One question from the chat: do you insure overseas AR for a U.S. lender?
Absolutely, very common. I have a client of mine who's shipping to a company called I mean, it's very TJX TJX Europe, TJX also Australia, and the factor, which is Rosenthal, requires the receivables of the overseas to be insured because they can't get involved in overseas stuff, which I'm not understanding why they don't do that, but whatever. So we have a policy. The lender, Rosenthal, is the loss payee on the policy. So now if there's a loss that were to happen, the trigger and the lender would get paid on that loss. Very common. A lot of the companies, I mean, all the companies we work with, they're European based. So we'll work with Allianz, Coface, Atradius. Allianz and Coface are based out of Paris. Atradius is based out of Amsterdam. There's a couple of other companies that deal with this on different levels. You have to really understand the intricacies of the companies and how they work to understand what can be a good fit. Okay, so yeah, I see Lewis, right? Has a bank ever be a loss payee? Always. We have that all the time. Banks are loss payees because the banks want to they want to lend against the AR. They want to be also, their AR is the banks sometimes will give a ABL, and whether it's an ABL, depending on how it's structured, the receivables is part of the leverage, and if the receivables aren't insured, they'll do better. So absolutely, very common, very, very common. I find most comically that, you know, banks will insure the receivables. They really have no clue what in the world they just did, but they check the box, which let them give the lending and stuff. And I have to sit there explaining to the lender what we're doing and how it works. And like, oh, that's interesting. I never knew that exists. But very common that we do that. Also, you know, if you think about it, many companies with the mindset they think domestically, there's a tremendous opportunity in the world. We have guys shipping to South America, you know, different countries all over. There's so much opportunity, and the people who capitalize on those opportunities can really make it big. They become, you know, you become a global company, and people restrict themselves because they don't even know where to start with that. Wait, how do I ship a company over in Albania or over in Europe or over in South America or China or Hong Kong without taking risk? Nobody wants to do COD. So the answer is credit insurance. That is how you mitigate that risk, and that's how you go and ship overseas in that capacity without taking the risk. So that's the way we unpack how that is. You had a question, Gershon? Nope, I guess we'll continue moving forward. So I want to give a couple of scenarios where we see in our brokerage firm what we call the pain point of companies, where we come in and we really help companies in that capacity, in those levels. So, you know, there's a lot of times a very robust credit process that companies have. Let me give an example. This is a short example. I was once walking to a company, a food company, and we started asking about what's your credit process? And it turns out their credit process was the three brothers of this company, who were the executives, who are making well into the six figures. Every time a new application comes in, they would sit, decide, make some phone calls. And then when somebody was in collections, they would sit there. Ultimately, what I discovered, I said, so something doesn't add up here. You three are executives making, very nice money. You're basically all day sitting making credit decisions or doing collections. That doesn't sound right. Why are you guys busy with this? It makes no sense. And, it took time until they realized, yeah, you're right. And we ended up taking a policy, and they put a girl in charge. And it's a very simple process. A customer wants terms, you put it in the system, it gets approved, go ahead, do the business. And if a customer doesn't pay, we have insurance, there's a deadline, you have a long period of time, you have a minimum of 6 months, 180 days, which is a long period of time. You're not forced to file a claim within. Generally, the amount of time an insurance company gives is going to be longer than what you currently give at your own company, unless you're completely reckless. So, and you could get extensions and all like. So it was outsourced to a girl. Her job was credit and claims. And it simply freed up three executives to go do what they do best, which is grow the business, focus on the issues, and focus on growing the sales. So that was one example where a credit process, which simply wasn't working. We once had another company where they hired a law firm to do all the credit process, which this was like the most bewildering thing to me. They were paying ridiculous amounts of money for a law firm to do credit checks on I had another customer who hired an accounting firm, but a prestigious one, who was charging ridiculous money to go do their credit risk analysis on the companies they're selling. But the first one, the law firm, well, their job was to do the credit risk, but their job also was when they defaulted when there was a default, they would be the ones collecting and filing suit against his customers, which was a straight up conflict of interest, because if they gave the permission to go ship the company who was not a great company, they also got the job to go do the collections, so they made money on both sides, which is a conflict of interest. So, those are two scenarios. Most of the time we find people just don't have a good grasp on giving credit to the customers. It's just a scenario where companies running and they're all over the place doing a lot of stuff, but there's no real grasp by what happens. And they go along, and as things, work out until something goes bust or something really happens. And, whenever we start with a new customer, I always say, well, what prompted you to reach out to us? What happened? And, oh, I was working, everything was good until a customer this. Or, I'll have a scenario, well, we have a customer who owes us a lot of money, we're very concerned about him. My old analogy is, when you work with somebody, you want to make sure to get in, when your kid comes over and he says, Daddy, I got to make, and he's holding his crotch, but he's all wet. So I always say, you want to really try to get a handle on things, because when, the kid's all wet, it's too late. I can't help you. So that's where it becomes challenging. Louis, go ahead. You asked another question. Are there any kind of companies, ARs you won't insure? So let me break that down to two portions. We won't insure because they're in some sort of default, bankruptcy, and where it's really bad. So absolutely, if a company is doing really bad, and they're, obviously from private to public, sometimes the insurance companies say, no, this guy's not creditworthy, we're just not insuring them. So you're going to have that. You will have that. Every company has that. There's times that we don't insure them. And I always say, You know, it's not going to be 100% of the time Blake that we get you coverage on everybody. There's going to be times again, hey, this guy, keep careful. Well, there's going to be times that, hey, you want a $250,000 limit? I'll give you 100 because you got to be careful with these guys. So absolutely, there's times that we want to ensure that stuff. And you know, generally, obviously, malicious stuff. You know, the insurance company's not there for you know something's going bad. Obviously, you know, most scenarios are, hey, we don't know, we just don't know. We're all nervous, and that's fine. You know, you could be concerned about somebody and get credit insurance, but obviously, if you know something malicious is going on, then obviously we don't want that either. Insurance companies don't want it either. Again, Louis, I'm saying that we're a brokerage, so I always say we're deal junkies. You know, it's our job to go make sure to find you a proper company. So, for example, I have a customer that sells, you know, all the baseball packet cards and all that stuff. They were selling to a company. They were selling to a company in Europe called UNI, a large, very, very large, you know, retailer there. And the insurance companies were max. So I had to go find, you know, my job is to go find an insurance company that will have the capacity. They needed a very large amount of coverage on them. So that's our job, is to make sure, hey, if this insurance company won't fit, we're going to find you one that fits. There aren't many players in the industry, and every company operates very differently. There's no one size fits all in this business. It just doesn't really work that way. You have to really know what you're doing.
I want to give a plug for the brokerage model. It's what I tell people when you deal with loan brokers. If you're in a situation where where you don't have a simple situation, then the benefit of having a broker is that they're going to get you in front of the right person the first time or the second time, not the 10th or the 20th time. And so that's where I think brokers, in really every industry, I had this when I used to work in bonds as well. There were certain things which basically were done without banks, and there's certain things where they needed the banks to essentially function as brokers, and those were the complicated deals. And we worked in the government sector, there were state laws about which deals you were allowed to have a bank kind of taking a cut, but they earned their cut because if it's not simple and not straightforward, that's where the brokers can really add a lot of value. And so what you're saying is basically that each one is very different. And if the consumer doesn't know who to talk to or what to talk or won't get their attention, that's where the brokers really will add a lot of value.
Correct. And to debunk a myth, going direct never saves you money. I'm not talking about because in the long run you lose out because of many. I'm talking about straight up, you don't get a cheaper policy by going direct. If anything, every time I hear somebody that's direct at a company, our attitude in the brokerage is like, hey, we can save you money, because most of the time going direct, you're not even competing again. You don't know what the competitive rates are to compare yourself to. So
right.
There's that component. And of course, in our business, it's very important to know which company does better in which industries, because you could be set up with a company who does really poorly in your industry, whether it's electronics or whether it's building supplies or it's a food manufacturer, and you're just the wrong carrier because they just don't have enough information about companies in your industry, and therefore you're not getting as many approvals as you should be getting. And when you're not getting as many approvals as you should be getting, I always say, we're all losing money. So that's kind of where you really short yourself. But of course, there's always that thing of going direct. People think that they get better rates, but in this industry, it's absolutely not the case. So, but yeah. I second you on what you said over there about the brokerages. I'm sure everyone in that field understands. Now, so I was speaking before a little bit about the concept of how the credit management, and that's really where it helps. And I always tell people, obviously if somebody has a policy and they say, well, I didn't take any losses, or somebody doesn't have a policy, well, I didn't take any losses, so why should they need credit insurance? And a lot of CFOs, and accountants look at that and say, well, let me look at the losses, let me compare it to the to the amount of losses that he should have taken, and well, if the losses were more than what the policy would have costed, let's get a policy. The losses were not, I don't need a policy. my answer to that is that's probably the most corrupt way to look at it. You never look at hiring a sales guy by saying, well, it's about over here. Our attitude is, hey, we're going to help you grow your sales and show you the potential of growing your sales without taking losses, and you'll see how much more money you could have made. It's about the credit management purpose. Whenever somebody wants to say, well, how do I bring it up to my customer? We say, what is your credit process? Can we improve and grow your sales? Are we restricting customers because of credit process? There's very few fine times. I always tell people, I'll sometimes meet a company. I'll say, what is your credit process? If we have no credit process, we go crazy. We give terms to anybody we can meet, and we just go crazy. We never got screwed. Then I always say, if a guy's going like that for 10 years, 20, just keep going. I mean, eventually you may get hit, depending how big it'll blow up in your face. That's the only way that you could possibly say, hey, that's when people ask, where do I show me scenarios I don't need credit insurance? If you found the industry that nobody ever gets a default, nobody ever gets stiff, nobody ever, and we never restrict terms, go crazy. And by the way, call me and let me know, because I still haven't found that industry. So I would love to know where that is. Also, I just to give a little perspective of flavor of us. I'm in the relationship business. I am in the business of building relationships, and I enjoy working with people. Our first thing I always say to people is credit insurance has to work for you. If it doesn't, I will be the first one to tell you. My team will be the first one to tell you. Because it doesn't work, then it doesn't make sense for me. It doesn't make sense for you. And our motto is we refuse to have unhappy clients. If you're unhappy with us, if you don't like the way we look, you don't like the way we answer, we respond, we take pride in our service at our brokerage, we take pride in our clients, we take pride in our relationships. And it's the key to building a business. And I always say we're in the relationship business, and through that comes our clientele, and through that comes our friendships. So that's the way we kind of build our motto for our brokerage. And we're one of the fastest growing credit insurance brokerages in the United States. I'm going to toot that, if you don't mind, just repeating what the insurance company told us. And we take a lot of pride in that, young blood and out in the field. And we travel a lot. We're all over, anywhere domestically. We obviously work with companies that ship overseas, but all our clients are domestic in the US. And obviously we have partnerships all over the world if companies need. But that's the gist of our brokerage. That's the gist of who we are. I know you said we have 40 minutes. Is that correct?
Yeah, approximately. You have a few more minutes if you've got more to say. If not, we can turn it back to the crowd.
I'd love to hear questions, thoughts. I'd love to hear feedback. Hey, you did a really good job, or you did a really bad job, or you missed out on this point. Constructive criticism is something I like as a challenge, as I always say. So, shoot it out. So, we can continue going. Any other questions? Any specific ideas? I always say that it's very hard to take a credit insurance policy and just say, hey, here's the broad, it fits everybody. It's always different, every single company. And that's where we need to know as experts how it's going to fit your company. And you're going to tell me, hey, we order goods from China and the goods are on the water, and it's, are we protected from a bankruptcy because it's not a receivable? This is stuff that we know, and this is stuff that has to be addressed. And we say, hey, yeah, here's what we have to do to make sure that it's insured that way, because yeah, it's not a receivable, and you made a good point. So it's very important to us to understand your business and understand how your business operates in order to properly assess and properly say, hey, this is a fit, this is not a fit, this company will fit. You need you need 1, 2, 3, 4 riders on the policy, which will make it fit. And our offer always is, if you know somebody, you have a policy, and you want somebody with a second set of eyes to take a look at it. I've told many people all the time, you have a good policy. I'll look at it. If you have a good policy and they're happy where they are, they don't want any change, by all means, I'll double check and make sure everything's in order. And I'll tell you straight up, you guys are good. So it's a very small world. There's not a lot of people in this business. And we take pride in our relationships of knowing other competitors as well. You build relationships and build business to competitors as well. So that's the gist of it. And that's the gist of our business. Gershon, let me know what I'm missing.
So I'm kind of curious if besides for buying credit insurance, which I get is probably a better option. Obviously, you're in that business, and so that's fine. But are there any tips and tricks you have for someone who wants to understand how to underwrite a customer? If someone said, you know what, for whatever reason they couldn't get credit insurance, I don't know, they're a criminal and you guys don't want to be involved with them. Are there things that you would advise someone in terms of how to look at a customer and decide how risky they are, if they're risky, how risky they are, et cetera, et cetera?
Good question. So one thing I will say, which is in tandem to the answer of your question, we work with puts as well. Those are hedge funds that hedge up against certain very high risk stuff. So if you're trying to ship a company, like we just did one on Big Lots, now they're filing for bankruptcy. It was way too risky for the insurance company because everyone knows it's a raveling, but a hedge fund will come in and sometimes charge much, much more. If it's worth it, it's worth it. It's just a numbers game. That's one way to hedge up against. When you're dealing with a customer, I always say that's real risk that credit insurance can't help you because you're not approved, or because what's your backup plan? I remember talking to a customer of mine in the apparel business, and he was shipping a company called Pegasus, which was back then it was National Store's second rebirth, and they were doing horrible, and I couldn't get him credit. I'm like, I was talking to this guy. I was like, Tony, I can't get you credit. The guy owes you 700 grand. You're doing 6 million in sales. This guy can put you out of business. What's your backup plan? His answer was, I don't have a backup plan. I said, well, you need a backup plan because that can put you straight up out of business. He's like, but this is the bulk of my business. So I said, you got to go in. If you're going to go in with risk, I get it. I get companies. We're an old business. We want to take risk. But if you don't have a backup plan, about if something were to go wrong, that's a real problem. That's where we see companies going out of business. So we see that a lot where a customer is selling somebody, his customer is defaults on your customer, and now your customer can't pay his bills because he wasn't properly. So not only your customer is your risk, your customer's customer is your risk. So yes, like you said in the beginning, we work with manufacturers sometimes, and we're insuring against a wholesaler, and then when we're insuring against a distributor, we're insuring all the way up. So if God forbid, the retailer defaults on the distributor, who will then default on the wholesaler, it stops right there and doesn't let the ripple effect go all the way up. If I were correct, I saw somebody had a question. Okay, are there any companies that you would like to, here, Lewis, are there any companies that you would like to work with better than others, manufacturing versus importers? Yes, it depends if you're a manufacturer, if you're an importer, it depends what industry you're in. If you're in electronics, if you're in, building supplies, if you're in apparel, food, it varies. It also depends on your customers. You may be selling to a customer that one insurance carrier is capped, is at capacity with. We need to go to the second one. So it depends on, there's no one size fits all for such a thing. So it's, it's not industry agnostic, and that's one of the reasons why we love what we do. I get to see companies in every industry. I get to hear the stories about people, how they started, grew. It's very encouraging. Get to meet a lot of people and really provide solutions. One of the things we love what we do. I love providing key solutions to my customers when they're around. And generally, we get calls all day. I have a division that just helps companies file claims all day. And that's our job. We help do the claims for you. And we help guide you when you're going through a scenario where, hey, it's becoming very challenging. I'm not getting paid. What do I do? How much time do I have left? How can I mitigate this risk? I want to get off of it because I don't want to, put myself in a deeper hole. And we work with companies all day, advising them how to do that, which is huge, which is absolutely priceless. Besides everything else,
Question. There's two industries I want to ask you about. They're both related to healthcare, but I will tell you that I have heard that lots of nursing home, well, I mean, I think it's likely that many nursing homes were overpriced and were bought by people who were trying to do these roll-ups, trying to create efficiencies that perhaps didn't exist, or they just overpaid. You end up with lots of nursing homes that are potentially in trouble. And I've heard that lots of vendors don't get paid. So I'm curious, that's an industry specific thing. Curious if you're seeing that, if you're involved in that, how that kind of what you have to say about that. And the other thing is in the home care space, we actually have some clients. We've done work, we do manufacturing distribution, but we also have over the years had clients in the home care industry and in the nursing home industry. Our clients in the nursing homes are usually the ones who sell to the nursing homes.
Yeah.
In home care, we've worked on both sides with vendor as well as home cares. And I know that in the state of New York right now, there's a high likelihood that many home care companies aren't going to make it. So there's some state, basically the state's taking over some contract. There are hundreds of home care companies. And if the state forces all of them to basically go out of business, then you have lots of home care companies there probably going to go bankrupt or whatever. Now, I'm sure, and I mean, I know that we have at least one client like this, but I'm sure there's many people whose I think we may have two clients like this, whose primary focus is selling into that space. So if you have the entire industry go out of business, again, like what are you seeing there? What is, and that's a current thing. The nursing home is more like a general thing, been going on for years. I don't think it's new today. This home care thing has been brewing for a while, but now's where it's coming to a head. And you know, if the state is successful, you have many, like the entire industry basically could go out of business. So I'm curious your thoughts on.
Let me answer the prior first. Nursing homes, we work heavily in that industry. Unfortunately, I try to stay away from it because it's a very challenging industry, let's call it, for lack of a better terminology. We recently, there was a group of nursing homes, the Levy Group, that filed for bankruptcy. There were about 280 nursing homes, a lot of them located in Florida. We had massive millions and millions of claims in that. Unfortunately, the nursing home space is not a space that we like to get into much. There's just too many claims. It's a challenging one. And they get flipped very quickly, and I can get more into graphic detail about exactly why, but I guess I'll leave it in a vague term. It's a very, very challenging industry. Anybody selling to nursing homes, it's a very challenging. Although the terms that was given, they used to be given were much worse than what it is today. So that component has gotten better, but unfortunately, nursing homes are going out left and right. When they say going out, they're filing, they're not filing, they're just closing doors, flipping. The nursing home is flipped to another one and just not paying any of the bills, and it's very, very challenging. Regarding the home care. So when the home care, for the home care themselves to get credit insurance on their customers, which really is the MLTCs.
That's not what I'm talking about. I mean, you can talk about that too, but.
Correct. So you're talking about, so that's one component which we do insure. Again, the MLTC is really backed by the government, so it's very rare that it'll be what's it called. When the home cares themselves going out of business, so on that end, it's not really, it's really not much of a difference because the home cares, remember, we're insuring their vendors against them. They don't really have any vendors. They're not really buying it. It's a staffing business in a sense. So
okay, but I'm saying we have clients who sell things. You sell
you will
gifts, you sell uniforms, you sell whatever, software, you sell services, sell whatever. There's lots of things. I mean, there's software I can think of right now that is only used in that industry. So you're going to have major exposure.
Yeah.
Now, software in general is probably pre-built. SaaS usually
not always. They get away with getting terms, but you are right. It should be pre-built.
But for many other services, and we've got clients providing other, other services or products or whatever, there are definitely things that home care as an industry is going to be exposed on. I remember I worked at a home care company once, and they had like a clinic that they would send everyone to, right? Because that was part of their process. So they had over 1,000 people, and every time there was a new person, they send them to a clinic. That was their thing. Like, I'm sure that they had millions of dollars outstanding to that clinic. Certainly hundreds of thousands at any time. This wasn't the biggest home care. You go to some of the larger ones, or someone who sells something that you can sell to multiple different home care companies, you can be exposed in millions and millions. And if the government shuts this down,
100%. The city of Detroit filed for bankruptcy, and I forgot what it was, but whatever. And you need to get credit insurance on them. One of the things, by the way, credit insurance protects you from political risk. So if you were selling to, I'm making it up, if you were selling goods to Russia before the war started, well, now there's a war, your customer owes you $1 million, but it's an act of war if your customer sends you $1 million because you can't transfer money in between. You're covered for that as well. So
cool.
Just to give you an idea, obviously it's not so common. It's very, very weird, the political risk component of it. But the idea is the same. The idea is you have no clue what risk your customer is at. It could be anti-dumping laws. It could be they're going to be hit with tariffs, and now they're suddenly out of business overnight. It could be like we're saying with the home care that they're being fought for with the government. Even the nursing home industry is being the AG in New York is going after them like bananas. So you don't know, and suddenly the market in electronics, if you're it's a very volatile market. Suddenly there's a glitch in the market, and suddenly the pricing went bananas, and your customers suddenly can't pay. Or most common, what the most common is? Amazon. Guys selling to selling on Amazon. I have guys all the time where Amazon shut my account. I have a friend of mine actually the other end where Amazon shut his account overnight. We had last year a client of ours.
You would pay out on something like that?
Absolutely. Listen to this. We had about 16 months ago, a customer of mine was a national company, was selling car parts to a company that was doing like 300-400 million on Amazon. Meaning the customer was called EOC Parts out of Florida, was doing a few hundred million on Amazon. One day Amazon sent them a letter saying, we're freezing your account because of suspicious activity. I don't know all the details of exactly what happened to the customer, but basically, I mean, his whole revenue was one customer. They talk about concentration, high leverage. This guy, his whole business, and he folded in 2 months. This company folded. My client filed a $2 million claim on them. He owed him $2 million. And all Amazon has to do is say, hey, we're reviewing your account. Some guy in India says, hey, we're reviewing your account. And these guys are choked to death. You can't stop an operation of hundreds of employees, and just because we're reviewing, and that's it. So anybody selling to anybody in Amazon, you better make sure that's insured, because those guys are very, very at risk. And it's not even their fault. We always say something like, well, they did something wrong. They imported goods or were selling goods that they shouldn't have been. No, a lot of times it's not their fault. But the problem is, by the time it takes them the 3 to 4 months to actually resolve the issue, it's too late. They held up their inventory, they held up the receivables, and the employees went to look elsewhere, and he couldn't pay his bills. So that's it. So very important. That was what we see the biggest risk today from companies that can overnight go like that. But so I hope that answers you on the nursing homes and on the home care component. But that's just the industries that you're aware of. So when they say tariffs are hitting, that can really affect people, obviously negatively. I have one customer of mine, he's thrilled. He sells US-made products. He said, that's it. Everyone's going to start buying by me more. So yeah, some of you what's it called, but at the end of the day, you don't know how that's going to affect everybody and all your customers. And if you have 500 customers, 1,000 customers, well, good luck managing that credit and deciding who's going to actually survive tariffs and who's going to survive whatever wave of challenge that's going on in the industry and who won't. So that's why you have credit insurance. It's not your problem, it's theirs.
All right. Just put up a short poll if everyone can answer a couple of questions. That would be helpful for us. Any final questions for Ellie before we wind down?
That's it. I think everybody totally understood every word I said. It was so clear. I don't think there was anything else. I mean, did I miss anything? I mean, you got Ken and Mike laughing. I guess either that or it's like, whoa, whatever.
a small question. I'm very new to this understanding of refactoring and accounts receivable. I'm like a tech nerd math guy dealing more with like, hey, this would be a cool toy for like little kids and an art exercise, whatever. Um, could you maybe, sorry, I missed part of the webinar. Um, is it really true that companies are covering the shipping charges, AR refactoring? This is a real thing.
Unpack your question, please.
Your
You need to be more
company,
specific at which
oh,
component
more
you're talking
specific.
about.
Uh, I'm selling a bunch of like dinky
Yeah.
Lego fake thingies, and I can sell them through Amazon, and I'm Canadian, and the whole world can go to war, and you'll cover my ass, I guess, is what I'm.
Yeah. Yeah.
And how does that make any sense at a financial logistical sense? Can I say that?
Well, the concept of insurance is pooling the risk. These guys, it's not a new concept. Credit insurance has been around for 100, 200 years. Uh, and the answer is they have reserves like any other insurance company, and they're reinsured as well, like any other insurance company. And the same way we could say, well, how do they surmise the risk when there's fires built up burning in California, the whole city down? What happens when suddenly all hell breaks loose and everybody's got? And the answer is they're prepared for that. So there could be all hell breaking loose in the world, but as I said, the insurance companies have been around long before World War II, and I think even before World War One, from what I was told. Don't hang me on that. But the answer is the world can be in turmoil. You're owed money. I need my money. Give me my money. You're my insurance guy. We signed up for a policy. I'm owed money from this customer. You can't pay me. Where's my money? And by the way, a credit insurance costs, a fraction of a percent. You're talking 0.2%, even 0.1%. People think, oh, it's costing me 1% of my sales, 2%, I can't afford it. And I say, no. 1% of your sales, 0.2% of your sales, that's the cost. And if you're paying more, call me up because we're all losing money. So it should not be there's a minimum premium of $10,000. I don't like working with little companies. But it's a fraction of your sales. So 10 to 20 basis points, and 20 basis points is a very high amount you should be paying. It's more like 10 basis points range. So, Mike, does that answer your question?
Yeah. Thank you.
You got it.
Can we go back to my question from earlier in terms of the price? If you're doing 10 basis points on, let's say, a $10 million company.
No, so 10, so again,
that's $10,000.
correct.
If you're doing 10 basis points on a $100 million company and you're insuring every dollar of sales, that's still only $100,000. So you can totally cut out the credit risk department from something like this, you're still going to need like half a person instead of a full person.
Well, I mean,
You need like a junior person instead of a senior person.
Right, like a secretary, just putting companies in. You can outsource it to somebody overseas, just put the company in, and you get a credit application from your sales guy and just put it in. And just, hey, ABC company based out of Texas, I need 50,000 of credit, get it approved, go ahead, send it to the sales guy. He's approved. The next minute he can go. You're getting answers instantaneously, sometimes a day or two, but more or less instantaneously. But also keep in mind, there's a minimum premium of $10,000. Just to give you an idea, a company doing 10 million in sales is going to be paying more like $20,000 in premium, which is more like 20 basis points. But when you're doing $100 million, you're going to be paying 10 basis points, which is 100 grand. You're doing a quarter, $250,000 or 250 million or 500 million. You can get it more like 8 basis points, maybe even a little better depending on the thing. But yeah, the more north you go, the lower the rate. It's a buying power element of things. So if you're doing 50 million in sales, you're probably paying 13 basis points. Generally, that gives you the idea. And you're going to say, well, if it's riskier, does it depend on how risky? The answer is not really, because if something's just too risky, they're going to say, hey, I'm not approving this customer.
Got it. But I guess for in that lower between, let's say, 10 and 100 million, you could really cut out, besides for the insurance aspect, besides for being insured, you're also potentially cutting out
I sat
labor
with
there.
the company. I sat with the company. I remember a large distributor, a national company, and we were talking about credit insurance. It was a lot. It was a few $100,000. It wasn't a cheap thing. And I asked the guy, I said, David, what is your current credit practice? So they were contemplating about the credit insurance. He says, I'm not telling you. I said, what do you mean you're not telling me? Why won't you tell me? Come on, we're having a conversation over here. He says, because you're going to love my answer. So I was confused. I said, what? He said, we have 34 people in credit. So I said, David, we signed the papers here. 34 salaries you're paying in credit. This is costing you a fraction. You're going to you're going to move 30 of those people out to another department. And because they're not going to be making credit risk calculations anymore. Let the insurance company do it for you. And we did sign, we did move forward, and we're working a good couple of years now. Great clients. So that's my first question. I would say, how many people, who's running your credit department? What are you doing? People are spending a lot of money on it. And they're not even making the right decisions because, again, very common. The credit person makes a wrong decision. The company gets screwed for 50 grand, even 20 grand. The boss is out, you're fired. You made a bad decision. Well, you're basically holding this person, and it's a conflict of interest. You want them to give credit, but then again, you don't want them to give credit. So you put them in a position where, hey, you're going to be demoted or fired if you can't do it. So what do they end up doing? They say, okay, we're going to be very strict. They tell all the sales guys, and you know the sales guys hate the most? That credit person who doesn't give any credit for them, and they can't sell.
Right.
So
I hear.
In this scenario, we let you sell, and sometimes the credit insurance company says no. Well, we can get financials from the customer. The customer wants the credit as well, so the customer can send this in its financials, and it's very common, very, very common. You see it all over. Hey, give me the financials. The customer gets financials. We get the credit that's needed. That's a rare occasion that we need it because generally they don't need financials.
Got it.
But really happens. I mean, there's ways to overcome a regular credit practice. So I think I went way over my time, but I'm still here.
Perfect. Thank you, Ellie. Thank you all for joining us. If anyone needs to get in touch with Ellie, wants to talk about yourself or a client, please reach out to myself or Brittany, and we will put you in touch or respond to the survey, or both. And if anyone needs a CFO or has a client that needs a CFO or has a client that is a CFO that still needs help, reach out to me and we will help you.
Thank you, Gershon. Thank you, Brittany. Thank you for joining. I had a ton of fun. I hope you guys did also.
Good.
And looking forward to hearing. And I always say I'm in the relationship business. Any questions, I'm happy to help. You know, not here to bust anybody's chops.
Thank you, Ellie.
Thank you.
Thank you.